Okay, so let's begin. Good morning, good afternoon, good evening to everyone. Wherever you are, welcome to our conversation this morning on financial services for platform workers. I am Javier Faz, and I'm the lead for digital business models for financial inclusion at CGAP. Platform work is becoming a relevant source of income for many low-income and for both skilled and unskilled workers. We are all familiar with platform services, as we've all grown accustomed to use them. Ride-hailing, deliveries, personal and home services, e-lancing, e-commerce. In an environment where the youth and working age segments are growing much faster than the supply of jobs, digital platforms help expand livelihood opportunities for poor. There are many aspects of platform work that are still unsettled, especially related to labor laws, worker rights, and social protection schemes. But the focus of CGAP's work is the livelihoods of workers, the way financial services can make this a more sustainable source of income and growth for low-income workers and their households. In this morning's session, we will talk about segments. Who are these platform workers? What are their needs? How can financial services make their livelihoods more sustainable and enable them to thrive? My colleague, Gayatri Murthy, will start by presenting the outcome of our research. And then our colleague, Rani Deshpande, will follow with a short moderated discussion with our distinguished panelists who represent fintechs and platforms in this space. I now hand it over to Gayatri.
Thank you, Javier. So welcome everyone to the panel again. My name is Gayatri Murthy. I'm a financial sector specialist at CGAP. Before we jump into the panel, I'll share some of the key highlights emerging from research that CGAP conducted in 2021 directly with platform workers, approximately 450 workers across 5 markets, which included India, Indonesia, Kenya, South Africa, and Nigeria. We also conducted an assessment of financial services that currently reach platform workers in India and in East Africa. And all this was kind of supplemented with research conducted directly with platforms, other experts and stakeholders, as well as extensive desk research. The purpose of our work, of the research, was really to shape and set out a state of the platform ecosystem from the perspective of workers. Although research like this is beginning to exist and is widely available, we thought what was best needed was a comprehensive piece that kind of laid out the state of the ecosystem and its potential to embed financial services. So here are the headlines. If any of you live in a big city in the world, which I imagine is a large proportion of you joining us today, then you know that in the lead up to the pandemic too, platforms have been rising steadily, both in the provision of goods and services, and have been fueling kind of large demands in cities with a growing aspirational class supporting this demand. And so that was true in the lead up to the pandemic. And of course, the pandemic created kind of these paradoxical effects where some sectors like e-commerce and delivery boomed to support all of us working at home, but then other sectors kind of received big shocks. So things that we'd been used to getting into our homes, like personal and home services, as well as ride hailing, suffered big shocks. Nonetheless, platforms are slated to continue growing in the new economy and are likely to attract large groups of individuals as well as small micro enterprises into their fold. What this means for us is that several verticals of work and business that low income and lower middle income people engage in will become digitized. And not just through large mega platforms that are either very prominent nationally or globally, but also through the digitization of labor aggregators, informal commerce, what we call largely social commerce that happens through social media, and all forms of other activities. So it's important to note that while by the kind of sparse statistics available, platform workers are a very small group, if we combine a lot of this digitization activity that's often messy and hidden, actually digital work, especially informal digital work, is rising fast and especially becoming a big source of income, secondary income for several workers and sellers. Who are these workers? I think what we found across the board was, yes, there's a lot of difference by the verticals. You can imagine someone who does ride hailing looks very different from someone who's an e-lancer. However, one kind of threshold reality remains the same. Most platform workers and sellers must have a smartphone. They must be able to use them. They must be able to read largely in English and also have a digital account, whether it's a bank account or a mobile money account in various markets may differ, but the fact that they should be able to receive digital money is important. While they work on platforms, many workers also retain other income sources. So this is not just a black and white reality where you enter platforms and that's it. You may go in and out of it. Some of them may have a primary source of income with platforms, and others may have various income sources. What's attractive to workers and sellers is the fact that the various features platforms hold probably represent a growing customer base that they can tap into and larger income sources. In fact, most of the workers and sellers we surveyed, 3/4 of them, in fact, said that their incomes had actually risen, that they were able to earn more in the platform economy than they did outside of it. What happens to workers and sellers in the platform ecosystem? What is their experience? It largely depends on which part of the platform economy they occupy. What is the work that they exactly do? And that in turn is determined by their skill set. Their skills determine which part of the economy they fit into and what type of work they do. So someone who does ride hailing has a very different skill set from someone who's a small e-commerce seller. Their access to capital then determines their ability to grow. So whether they can acquire new skills, expand their inventory, other kinds of things really determines what their trajectory looks like. As might be obvious to you, a person's gender is incredibly important in what happens to them in the platform ecosystem. It's not only true. The only thing true here is not that there are few women in ride hailing and delivery, this is true, but also that women occupy particular spaces like home services, personal and grooming services, and that's where you'll find a large chunk of women working, finding new opportunities, but largely replicating the norms that exist in their society on the type of work they can do. Women are also a notable presence in e-commerce, small merchants. They also, when they have the right skills, go into e-lancing, but their experiences are specific. Their experiences may be different from the mainstream platform kind of experience. And this is worth noting when we're thinking about financial services. We have a whole deck out on this topic, so please do refer to that. Largely when on platforms, the promise of platforms do come true for workers. There is a level of flexibility they can exercise. And given the kind of codification of tasks and work, there is a level of autonomy that they can also exercise on how they conduct their business or work on platforms. However, this is a mixed bag still, and therefore there are negative experiences that do show up for workers. The ones that rise to the top, again, we've heard about them. They are the fact that incomes may eventually decline. They may prove to be very volatile, and largely there might be a change in rules on how their work is defined and conducted. This is a factor of platforms still being a force that is, while large, still stabilizing itself, and many other factors that I think we'll talk about shortly in the panel, and you may have also read about in the news. Another experience that I want to emphasize, which is I think relevant for this discussion, is how the kind of lack of financial services or tools for workers and sellers really affects and I think limits their potential on platform work. So like I said, all of them have to have bank accounts and cell phones, mobile money accounts to receive payments. What is true actually right after that is that beyond these accounts, very little financial services are available to these groups. So only 16% of them had taken loans to support their work. Less than 15% had ever accessed insurance. So what this means is, while there might be account access, holistic financial inclusion doesn't exist in this group. Even though they are literate, they have smartphones, they have large-scale connectivity, the work is incomplete. And therefore, the advantages of platform work, which is the growth potential, gets inhibited, but also some of the risks are far riskier without the support of services like insurance, savings. And this is worse for women, who tend to be more excluded in any kind of socioeconomic group than men, and therefore here too find a kind of a bigger difficulty in accessing the investments or the capital they need to grow. So how would financial services support these workers and sellers? Largely, their needs are not very different from the needs that other workers and sellers in their category would have. So the need to have startup capital, the need to protect their income, and to kind of plan for large goals. These remain the same. However, what platforms represent, which we saw on the other side of our research through the assessment of services, platforms represent a unique opportunity to actually tailor these services a lot more, to tie them more closely to the work people do, and to embed them quite seamlessly into people's lives and livelihoods through whether these are automatic prompts, sweeps when an income is earned. There are many tools and features that could really bring these services to life for workers, and an environment of trust actually create a pretty strong support system for them. However, and this is towards the end of my presentation, this ecosystem is still a nascent space. So while services like this for workers are beginning to exist, they are yet to fully reap the benefits of the ecosystem or provide the full set of value that workers and sellers could really enjoy. So the data, while considered a silver bullet in many discussions, is yet to be fully set up to benefit workers through larger loan amounts, more tailored insurance, and things like that. So services, while they exist, are at a stage where their delivery may not be fully figured out. Their features may not fully suit the workers and their work. And a lot of this actually depends on the infrastructure in a country. So platforms may exist and payments may exist, but without mature payment systems and without forward-looking policy that actually allows the integration of these services, actually much of the work remains incomplete. And so there is room to go much farther than we are at this point. And there is plenty of promise that remains promise and not realized delivery of services. Finally, I won't dwell too much on our recommendations. I think you can read them in our report, but the work ahead is pretty multidimensional. We think that platforms and financial service providers must innovate more so that there is more visible innovation that the sector can learn from and replicate, especially not just on putting services there for services' sake, but actually making them appropriate, seamless, and doing so in an environment of growing worker trust in these platforms. However, this would not be complete if those pieces of policy and capital support and other kinds of knowledge support are not available. So there is a role for policymakers to play. No financial services can work in an environment where there is no well-being and where there aren't worker rights. So I think this is important that we focus on these goals holistically, and that policymakers think not only about the rules and rails, but also worker well-being. Finally, funders, if there are any in the room, and this is a new space for them, funders also have a big role to play to promote certain best practices and standards and define kind of what are best practices that others can adopt and share across different markets. With that, I'll say there's a whole lot more on this research that's available on our website. Here's a link here. We look forward to engaging all of you on this. With this, I'll hand over to my colleague Rani Deshpande, who will moderate the panel ahead for you. So over to you, Rani.
Thank you, Gayatri, for that great presentation. And before I go into introducing our esteemed panelists, I actually want to ask everybody in the audience a question. My colleague Daniel, I think, will put that up as a poll right now. So the question is, after having heard a very high level view, there's a lot more in the report, a very high level view of the evidence that we've gathered. What's your thought? How important do you think it is for platform workers to have access to these kinds of financial services, either mediated or facilitated or offered by platforms? You can put your sort of very important, not important answer in the poll. That's great. I see the answers rolling in right now. And if you're so moved, tell us why you think so in the chat. And while those answers are coming in, I will turn to our panelists. I'm very pleased to have with us today 3 representatives of the organizations that are actually out there fulfilling the kind of demand that we saw evidence for. And I'm going to introduce them simply in the order in which they appear on my screen. So we have first Tanah Sullivan, who is the group head of sustainability at GoTo, which many of you may know was formed recently from the merger of Gojek and Tokopedia in Indonesia, where she leads ESG efforts across the organization. And before that, Tanah was with the World Economic Forum in Switzerland for many years, leading partnerships across ASEAN and multiple sectors. Welcome, Tanah. We also have Rohit Rathi, who is the CEO and co-founder of KarmaLife, which is a fintech that is providing credit on tap, I think is the way they put it, for workers, including platform workers. And Rohit is actually a serial entrepreneur, having founded the organization that was the originator of India's first tablet PC prior to KarmaLife. And then finally, we have Tim Jamieson, who is the VP of Payments and On-Demand at SafeBoda, which is a very well-known two-wheeler ride-hailing platform in Africa and is also expanding to a range of consumer services, including financial services for its platform workers. And prior to SafeBoda, Tim held a variety of roles in corporate banking, macroeconomic consulting, and the startup world as well. So welcome, Tim, Rohit, and Tanah. So you all have heard of the presentation, you've been involved in our discussions, and I think if everybody sees what I do on screen, you also see the results of the poll, with a fair majority of people thinking that the offer of financial services to platform workers is very important. So now I want to turn that question to you. How important do you think it is? And how did you come to that conclusion? Who are the platform workers that you work with? How did you observe financial service needs amongst them, if you did? And then what's your approach? Why are you actually interested? Why is your organization interested in fulfilling those needs? And maybe I'll just ask each of you to take that question in turn, starting with Tanah.
Thanks, Rani. So, I mean, just to give a little bit of color in terms of the context that GoTo operates in, right? So we have around 2.6 million driver partners. We have over 15 million merchants, of which most are micro and small and medium-sized enterprises who rely on our platform for their livelihoods. And so I think we are incredibly uniquely positioned to be able to provide the kind of financial services and products that will help them from a financial inclusion perspective. I mean, it's built into our business model. We are nothing but a digital platform that provides access to, business opportunities, to selling to consumers across Indonesia and the broader Southeast Asian region. And so because we are a group of companies that encompass everything from ride hailing to food delivery, logistics to e-commerce and fintech, I think we have a huge responsibility and scope to be able to provide the right kinds of financial services and products for our key stakeholders, our priority groups. And in this situation, we're really talking about the driver partners who make up of, around the 2.6 million driver partners across Indonesia, Vietnam, and Singapore. Look, I think because we have so much data, we are a tech company after all. We have so much data, not just on their kind of the orders that are happening or being facilitated through our platform, but also in terms of their income generation, plus then their spending behavior and habits as well. And so I think that provides us a very comprehensive view of where they're at, and then allows us or informs some of the targets that we've set and some of the commitments that we've made around increasing their access to the right kinds of non-predatory financial products and services, as well as making sure that we're developing the right kinds of products and services to help them get ahead from a socioeconomic standpoint, and improve kind of their overall livelihoods, which, by the way, doesn't just include income, but a lot of other indicators that we're tracking as well. So I think that's the general broad scope of what we're looking at, and the target stakeholders that we have in our midst.
Great, thank you so much. Tim, let me turn to you. Does Safeboda approach financial services for its drivers from a similar perspective? Do you have, what I heard very highlighted in Tanah's answer were the social objectives. You have social objectives and business objectives. Are there limits to the business case? What can you tell us?
Yes, I think so. For those of you that don't know Safeboda, very similar to GoTo, we are a two-wheeler ride-hailing business, headquartered and founded in Uganda, but also in Nigeria as well. And so I have quite a similar profile, I guess, to GoTo in terms of the drivers and who we're kind of and who we're working with. I mean, I think for us, it probably boils down to kind of two parts, right? There's the community element. So one of the reasons that Safeboda has been so successful since its launch 6 years ago has been its ability to go super deep in the countries that we're in and build a community with our drivers. So, we've seen the large ride-hailing companies like Uber and Bolt sort of try it in both of our markets. And we're still, well over 95, 96% of the formalized Boda markets, so two-wheeler ride-hailing markets, sort of where we are. And the reason that we've been successful is because we've been able to build this community around our drivers. And that community kind of falls into a few different parts, but primarily it's around making sure that they see continued value from our platform. And that's about earnings, that's about utility. And for us, from a business perspective, it really boils down to kind of one thing, and that's driver retention. So for us, for a driver that's using the Bolt app or the Uber app, it's relatively low utility because there's sort of zero embedded or explicit financial products within those sort of ecosystems. But for us, we have this kind of slightly strange dynamic where our drivers, particularly when they first join Safeboda, are extremely financially illiterate, but very quickly some of the heaviest users of embedded financial products. And by that, I mean things like asset financing for their bike, for their mobile phone, and for their equipment with Safeboda. So they very quickly go from, whether they kind of explicitly think about it in terms of consuming financial products, but they go from being, so very marginalized to extremely engaged as capital is deployed to help them sort of support their earning capacity. And so for us, our kind of raison d'etre as a business is really helping communities thrive, and how that translates into the business case for delivering financial products to our drivers is really about driver retention. So we have like one of the highest retentions, if not the highest retentions of drivers in the world. They don't churn from our platform. It means that our cost base remains low because we don't need to keep recruiting drivers and training them. We have experienced, long-standing, driver partners on the platform, and so it kind of all feeds our ecosystem. So there's both the kind of social side of things, but an extremely strong business case for it as well.
Great, thanks. And Rohit, I want to get to you, but I know that you have a slightly different perspective as a fintech. So let me just add one more follow-up question for Tanah. Tanah, how large does retention loom in GoTo's rationale for its financial services for driver partners?
Sorry, I caught how large is what? Sorry, Rani?
How important is retention for you guys?
Incredibly important. I mean, the driver partners we work with are literally and figuratively the engine that drives not just our ecosystem, keeps our ecosystem moving, but also our company, right? We would be nothing without them. And so I think our responsibility, it's not just the right thing to do, as a lot of companies, you hear a lot of companies, so corporate saying now, but it's literally going to be our license to operate. We have to demonstrate how our company's growth and our business priorities are very much in line with the best interests of our driver partners, because again, as I mentioned, without them, we would be nothing.
Great. Rohit, turning to you now, I know you have a slightly different perspective as a fintech, and I imagine that since this is your bread and butter business, the business objectives will be paramount. But tell us a little bit about the types of platform workers you work with, how you figured out their financial service needs, and the sort of goals underpinning your approach.
Sure. Thank you, Rani. Hello, everyone. My name is Rohit. I'm founder of KarmaLife. We are focused, as Rani mentioned, we are focused on providing financial services to gig workers. We work with platforms across the board. We work with e-commerce company, last mile, city logistics, food tech company, mobility companies, temp staffing companies. India has almost like 400 million plus blue collar people, and around 15 million of them are digital gig workers, the workers which is actually associated with the platform. Typical profile of these people, and all of them are important for the solution which we have built. So I thought I'll just set up the context of it, right? So typically people, the gig workers in India earn between $200 to $350 a month. Average age is around 27 years. 30% of them are a migrant. A large percent of the people actually come to the cities to work. And around 60% of them actually do this work to support their family. Less than 18% of them is actually doing this for the pocket money. And also, we have a different varied payout cycles. People are paid on a weekly basis, fortnightly basis, or a monthly basis. They are paid as a fixed plus variable, and otherwise they are paid as a per job basis. So it is a very complicated ecosystem of the gig workers. And based on our study, which we did with, as part of, before we started the KarmaLife, we spent more than a year to really do the study, that found out that more than 80% of the people reported a shortfall of the money before their payout day, irrespective of their payout cycle. Less than 25% of them had any sort of savings. Less than 20% of people see insurance as a viable solution. And when we asked this question, saying that if you stop working right now, how much financial viability you have, and less than 3 months, the people would stay financially afloat less than 3 months, right? So a combination of all those things led to us to go back and work on a solution. We found out what the challenges were, that not only institutions, financial institutions know how to underwrite these people. There is also a problem at the user side of it, where they do not really trust these institutions, right? The business models very, very complicated. You cannot really, you can't really understand that, you will be charged something as a percentage of the money which is being taken. They would like to see transparency and easy for them to understand that part. The needs were real time in nature because of the financial literacy problem. If they have a need right now, they would want to have money right now itself, right? Instead of you telling them after 2 days or 2 hours that this is what you will be eligible for. So keeping all this in mind, we worked with these platform companies. One of the largest e-commerce player was our beta partner, where we were able to get access of the work data, and we utilized that for the purpose of defining the limit and eligibility. It is almost like 100% inclusion program which we run with them, where the users, gig workers, can access the earned wage which they have earned with the platform, wages which they have earned with the platform before their payout day. And we found very interesting results actually with that. This is one of the impact study which we did with one of the research agency, that more than 60% significantly after they started to use the solution. Platform have seen value that the worker productivity have increased by almost 32%, and at the other side of that is that the churn has reduced around 20 to 40% level. So the coming from, there were studies which were done in USA for white collar people, where the employer linked finance has helped to increase the retention and overall productivity. But this is the first time which was done in India, where we found out what we found out was that even for the gig workers, even for the temp staffing, even for the the workers which are not permanent for a platform, the platform linked financial products can actually have the similar results, similar benefits as it was seen for the white collar people.
Great. That sounds like a litany of benefits, and I definitely want to come back to that. You've also segued us nicely into the next sort of set of questions that I have for the panelists, which is, how's it going? So you've told us a little bit about the way in which KarmaLife is setting about fulfilling the demand that you've seen. Tanah and Tim, can you tell us a little bit about the types of financial services that you are currently offering to your driver partners, and the progress you've seen and the challenges, any challenges that you may have faced? And maybe I'll start off with Tim.
Thanks. So I guess our financial services are probably divided into two parts. There is the kind of productive lending that centers around giving our drivers the tools to be effectively to earn. So this, as I said before, this is around bike financing, mobile phones, and safety equipment that all of our drivers purchase from us. So I think, but this is sort of quite biased because they literally couldn't work without any of these. And so the very interesting thing is that really across all these three verticals of equipment, phones and bikes, we see an extremely high repayment rate. So surprisingly high, I guess, when you kind of consider both the asset class, but also the region, but maybe unsurprising when you consider it's like the economic backbone of effectively all of these drivers. So with this sort of like the embedded finance piece, the provision of it tends to be more manual, quite difficult to do because it's fully informed, dispersing funds, delivering bikes, etc. But tends to have a much lower kind of run cost and also much higher repayment. The second part is around the more kind of day-to-day, I guess we call it like explicit financial products. So we're obviously working with CGAP at the moment for the development of a savings wallet to try and encourage behavior of our drivers to be more sort of financially responsible, to save more of their earnings by segregating their wallet. So our drivers get paid all of their earnings into our app, into our wallet, but providing them with a kind of the segregated one, we're hoping to encourage them to be, I guess, more prudent around savings. And within that as well, they have access to things like school fee, the ability to pay school fees, airtime, data, utility bills, etc. So on the kind of the embedded finance side of things, like it's, we've been doing it now for 5 years, and driver take up strong. On the kind of the more nascent sort of voluntary sort of financial products like savings, I think that's where the kind of softer education piece is going to be more important because there's less of a kind of an upfront economic benefit to them necessarily. It's more about a behavioral change.
Maybe I'll just jump in then. Next, no, I mean on the softer part of it, for sure, we're also investing quite heavily into kind of awareness raising programs and around financial literacy and financial empowerment, I would say, about what it means to think more long term about I think the financial security and livelihoods overall for our driver partners. Remembering we also have another stakeholder group, which is our merchants, right? These are two different groups that have very different needs from a financial perspective. And so we definitely need to build kind of customized, tailored offerings for both of them. Now, we cannot force these things, upon them. And so a really interesting anecdote, I mean, I've spent some time as an actual GoSend driver, which for those of you who aren't familiar with, it's I'm not brave enough yet to ferry around actual humans, but with your packages, it's 100% safe. You will get your package at least in a relatively okay state, but with me as your driver. But I think for me, it was really important to actually understand from a personal perspective what it was like to be a driver. And what we learned was that it's that from all of the data that we've collected and all of the things that we do from as informed as possible, at the end of the day, it's up to the driver's behavior is very unique. There's all kinds of cultural contexts and layers that we also have to consider when we're coming up with a lot of these financial products and services. One of the assumptions that I personally was, surprised about is that we know that our drivers are at a certain threshold or point of the day when they earn a certain amount, they drop offline. Now, whether that's 4 hours or 8 hours of work is irrespective of irrelevant to them. And for me, you know, I spent, let's say for sake of this conversation, that, you know, that was $10 US, you know, and if I earned that in 4 hours, I would think, well, give me another 4 hours and I can earn $20 and I can pocket that $20, right? That extra $10 can go to whatever. A lot of our driver partners, at least through the focus group discussions and consultations we've had, they're spending that additional time, you know, with their families, being able to pick up their kids from school. The value system is very different, right? Whereas, you know, because that's, you know, to us, it might be more important to save that money, but for them, actually spending time with their family or picking up their kids or doing what have you from a personal perspective is much more important. So we're trying to integrate a lot of these kinds of considerations into what we're planning and offering, and just making sure that, you know, we have this ongoing partnership with CGAP, which is incredibly valuable. Try as best as possible for us to reduce our barriers to financial services, improve overall financial literacy, offer the kinds of programs like savings, insurance, microloans that are, again, non-predatory, reduce the operational expenses of our drivers as well, whether that's through some of our kind of offerings for reducing, you know, gas, petrol, whatever, wherever, depending on where you are in the world, costs or maintenance costs for their vehicles. And then, you know, and then from there, I guess, like, try as best as possible is to make sure that we're tracking and monitoring the uptake of that on the driver's side and making sure we're continuously engaged with them and communicating with them to ensure they understand the benefits also of a lot of these programs and offerings. For the merchants, it's really about business growth, right? So this is, you're talking about a little bit more, I guess if I can use the word mature stakeholder group. They already have their own enterprises. We want to basically give them the right access to the right digital and financial tools to be able to grow their businesses on our platform. And so there's, you know, we have a peer-to-peer lending scheme for the micro SMEs on our platform that enables them access to funds. And we have a bunch of digital and financial solutions and business management tools for them also to kind of best leverage all of the opportunities on our platform.
Thank you. That certainly gives us a ton to think about. And I would love to, maybe we'll pick up on this a little bit later, but I hear this theme of sort of what we think of as financial literacy, of educational efforts running across some of your comments. And I'd love to come back to that a little bit later, but more to the point right now, let's talk about critical obstacles. So I see these great ambitions, which we, of course, at CGAP fully support. What is it, if there was one thing that would need to be changed, either internally or externally, you know, ecosystem-wide, what is the critical obstacle, do you think, right now standing in the way of realizing the ambitions that your organizations have for these types of financial services? And I'll open that up to anyone on the panel.
Sure. So, you know, you know, we as a country have a very mature or robust ecosystem for digital payments, right? UPI clocked 5.4 billion transactions last month, right? Which is like $120 billion worth of transaction which happened. So I think as a country, we are doing great in terms of the digital payment services. We have a stack which lets you do the KYC in a digital way, which is great in that sense to give you experience. But, you know, one of the struggle which we have found out was a lot of people, a lot of gig workers does not really have the documents which is required for you to do the KYC. So that's one of the constant fight which we have to, you know, how to meet the requirement of the regulators in terms of the KYC, and explaining that to the gig workers was one of the challenge which we are trying to overcome in a different way. The second is there is no standard schema of the work data across the platform, right? Everyone stores the data in a very, very different way and has a very different meaning of that, right? So while, you know, you can treat that as an opportunity also, because that's a work of companies like us to really sort of you know, try to make a common sense out of it. But I think things would have been far more easier, better, and much more the scale would have been entirely different if, you know, there is a common schema which is followed for storing the data of the gig workers on work data on the platforms.
Thanks, Tim. Tanah, any thoughts on that? The critical obstacle standing in your way.
I can jump in, give Tim a little bit more time. It looks like he's pondering. No, look, I think there's the key challenge for us is around, as I mentioned, but it's kind of alluded to before, is the overall awareness of what it means to be financially secure from a long and be thinking about these things from a long-term perspective. I mean, a country like Indonesia, we have seen a socioeconomic mobility that has never been seen before. It's almost unprecedented in previous generations, right? This includes also even a purchasing power that previous generations did not quite have, or the kind of mobility between classes that we've just not experienced before. So a lot of these things, or trends, at least from a macro level, are very new to us. And I think as a society, it's about making sure that those that have been historically underserved and excluded from the financial system in a country like, in a market like Indonesia, is that companies like ours, where we have some kind of role to play to distribute and deploy a lot of this information to empower, whether it's our driver or our merchant partners, with the right, not just the knowledge, but also give them a path and tangible, practical solutions to be, and tools to be able to, that they can use at their disposal to be able to, move up, I guess, or become more financially secure and I guess what we consider financially safe. The problem is, of course, then it still comes back to awareness, right? No matter how many, we can bring out a wealth of financial products and services, but if there's minimal knowledge, that means there's minimal uptake. And so this is not a sequential thing, I think, for us. It's something we have to do in parallel, but definitely an area that we're investing in, but it remains a key challenge for us.
And I think for us, I mean, we're very similar, except probably, decade or two behind in terms of the socioeconomic and disposable income in Uganda, and also kind of region in the tier 2 cities in Nigeria. And so for us, we do a lot of work around kind of basic financial literacy training, but ultimately it really is about providing kind of a use case that is essential and critical for the drivers, for them to engage and to use it. So we've taken lots of feedback in terms of how we've designed the savings wallet, for example. We know there is demand for it, certainly from a core of drivers, but there needs to be kind of a very strong sort of economic rationale still for what's the immediate benefit of doing. So I mean, we're not at the stage of kind of of financial literacy of people that are thinking the benefits of a product over a 1 to 5 year horizon. It's very much, how does this get me through to the end of the month? How does this help me manage my school fees for the next 3 months? And it's about us designing kind of product that makes it very simple to kind of lead better financial outcomes without necessarily having to spend a lot of time explicitly explaining and convincing, which, although is kind of great and we continue to do it, actually for workers that have got pretty low marginal income, they're better than others in the informal sector. It really is determined by the kind of commercial end of day salary really for them, and so it's our responsibility to build a product around that.
Yeah, I think,
which isn't easy.
That's a critical point, absolutely, and probably even more important for savings than something that might have an immediate cash flow benefit, such as credit. At this point, I want to bring Gayatri back in, and I'd like to open it up. We've been getting some great questions from the audience, rather. So I want to take some of those, starting with a question from Hillary Miller-Wise around the benefits, but also the risks that could be represented by embedded finance offered by or through platforms. The lack of opportunity to build a credit history, credit reporting risks. Would love some of your thoughts from the whole panel, and Gayatri as well, about how you're thinking about and managing those risks for your worker partners as well as the benefits.
Yeah, I'm happy to start on this. I mean, I think there's two parts to this that make this really interesting. So in kind of an ideal world, there'd be extremely strong external kind of credit reference bureaus or data sources, as Rohit sort of alluded to before, where across various verticals and platforms, you could feed this data in to provide sort of suitable, well-priced access to finance, embedded or kind of explicit loans. because of kind of an accumulated credit data, right? But the reality is that, as Rohit also said, this remains extremely siloed, and siloed within the platform that the gig workers earn their income through. So if we have some drivers that might be on Uber as well as Bolt, as well as Safeboda, we have no view and therefore no kind of credit view from the work that's done off platform. Now that's obviously a kind of a challenge, and one that means that even for kind of a single platform to offer financial services might be a challenge, let alone a bank or sort of an MFI or someone outside of the kind of platform, as they have access to the data. The flip side to that is we also have extremely good data. So for us, our drivers typically use us between sort of 10 to 15 times a day. We see their kind of consumption data for things like airtime, bills, data, as well as their earnings, and also the kind of more alternative data sources that you kind of see in terms of idling time online, etc. So I think there's the kind of two parts to it, which is actually like in sort of the absolute, it's a real challenge for gig workers because their data exists in one place, and therefore unlike a consumer, aren't building up kind of a credit history across sort of multiple touch points and institutions. However, if the platform is in a position to deploy their balance sheet to the gig workers, then they've actually got really fantastic, extremely deep data with which to deploy balance sheet and capital.
Rohit, I think you had touched on the data issue as well in your previous comments. So in addition to sort of hearing about how you think about managing some of the risks that might come with credit, and I might add to that, even the risk of potential perpetual or over indebtedness that may come from sort of the bridge financing. If you could touch on, in the Indian context, which in the world may be amongst the most ripe places to have a kind of common data portability system. What could that look like? What would that need to look like to solve the problem that Tim and others have signaled?
So I think I agree with Tim on the richness of the work data, and that is, we believe, is sufficient for you to do the credit risk assessment. There's no central place for anyone to get this data, and I'm not very sure that whether the platform provider would agree to do that part, because at the end of that, that's their asset, right? In India, you need to report back the micro loans or the loans which is taken against the microcredit which is taken against your income, right? So we don't have that problem. That it does not really help. It does really help to the user to build the credit history actually over the period of a couple of months. If we have to imagine, right, that how it would look like, at least as I said, right, common parameters, which is number of trips they have made, what kind of digital earning versus cash on delivery, cash earnings they had, number of cancellation which they did, and so on and so forth, across all the job types, whether it's a ride hailing, e-commerce, food tech, we believe would be helpful for more and more institutions to really provide these solutions to the gig workers. Right now, it's actually very central to companies like us, which has been working with these platforms from last more than 2 years, right? So the knowledge is residing with the player who have worked historically with them, but there is no longitudinal view on the data across the board, right? So I don't know what's the solution for that, but the data is, that's one of the things which we thrive for, that it should be able to pay back. He should be able to pay back in the next payout cycle. Reporting to the bureau is immersed in India, so that's not really a challenge as of now in India. From credit history building point of view.
Great, thanks. Tanah, from the Indonesian perspective, how do you think about managing the risks that may present themselves along with the benefits of embedded finance?
Well, look, I think let's stick with the driver partner example, right? I mean, when we're talking about data here, we have incredible amounts of data that's happening every transaction on our platform. We know where our drivers are going. We know how much generally they're earning per order. And we know how much they're spending as well, because we are a closed ecosystem. There's lots of opportunities also for them to purchase, and we give them incentives to purchase some basic needs and services on our platform. So all that actually we're working with the CGAP team on is building kind of a credit profile to reduce the risk as much as possible of each of these driver partners, so that financial institutions here in Indonesia have more appetite to to serve them. Because essentially, I mean, even though we have our own kind of fintech arm and we work very closely with the financial institutions here in the country, I think because there is no formal profile for each of these driver partners, for us, it's about harnessing the data that we have to be able to lower the risk assessment for each of these driver partners, so that they are bankable, that they are legitimate parts of our economy, because for all intents and purposes, they're still very much informal here in Indonesia. And so I think for us, it's about closing that as much as possible and providing that kind of confidence and through the data, through building these credit risk profiles for each of these drivers on our platform, and working with the financial institutions hand in hand to make sure that the drivers do get access to the kinds of products and services that are actually going to be beneficial to them from a financial inclusion perspective.
So that's interesting then, because, for what Rohit was saying, it really made it sound, and I agree, that it's difficult to align the institutional incentives to create a truly central repository of this kind of data. But it sounds like what GoTo is doing is getting part of the way there, at least in terms of opening this data up in an internal marketplace and opening it up to a host of different financial players. So sort of partial solution.
Exactly.
Yeah, I mean,
Sorry, Tim. Go.
Sorry, Tanah. Yeah, I think there is sort of like a middle ground there, which is the reality is that for most platforms, it's not their balance sheet that they deploy to the gig workers. So we partner up with financial institutions to service our agents, our merchants, our drivers, our passengers, because the reality is that most platforms, certainly the smaller ones, tend to be kind of balance sheet light. And so although that there's not this kind of explicit kind of open API access to the data, actually platforms bring in kind of appropriate financial institutions to serve the gig workers, and have varying degrees of kind of data sharing within them. Some where it's kind of fully protected, and others where it's kind of the data is very open. And so although there's not sort of the external source, actually there is access to kind of the data for third-party financial service providers within the platform ecosystem.
Well, that actually brings up a question that I wanted to ask, and I think we have a perfect constellation of people to ask it to here, and that is about those partnerships between financial institutions, fintechs, and platforms, because as we know, that's kind of where the rubber hits the road. And we can have all of the strategic rationale that we want, but unless the partnerships work, nothing works. So I would love to hear from each of your perspectives, what makes a good partner? Rohit, maybe starting with you, to put you on the spot, what makes a good platform partner when you're trying to sort of mount these joint services together? And then from Tanah and Tim, in terms of what makes a good financial institution or fintech partner. And then Gayatri, I think we probably have something to say from our perspective and our supply side research on this, and maybe I'll bring you in as well on that.
See the ask from the platform. So it's first of all, it's not a zero-sum game in that sense, right? When we started, there was a clear, the clear question from all the stakeholders, right, within the company was that who's the actual winner in this, right? When you're providing services, is it the platform which is getting the most of the value out of it? And over the time, what we realized that it's actually the platform gets a benefit of retaining people, increased productivity, right? Which is the biggest challenge they have right now. There's a shortage of delivery people, and if you can retain a worker who has worked with you for a couple of cycles, couple of months, that's the best outcome for them. From the user point of view, is getting access of these services, which is far more cheaper, far more affordable, and far more deeper in that sense, because it helps them to build a great history over the period of time, right? From the financial institution point of view, right, they are serving to a space which was not served earlier, right? See, in India, if you're running less than 3 lakh rupees, it falls into the PSL category, priority sector lending category, right? and every institution has a mandate to serve the PSL, right? And they just do not know how to do that part. So I think, and platform like us actually gets a benefit, can get a benefit of, working with the institutions, designing a solution which is contextual, relevant for the people, and at the back end give the comfort to the financial institution that, it is not as bad as it looks like to the people, right? So I think what we've realized over the period of time is that it's not a zero-sum game, actually. Everyone can be a winner. It's just that there is a lot of apprehension. I remember when we started our first partnership, convincing the partner to expose the data to us was a big job, right? You need like-minded people to really say, okay, I'm going to try it out. Let's see, what does it take to do that part? Of course, COVID sort of helped those conversations because platforms genuinely wanted to help their gig workers, right? And they were actually open of exposing the data to companies, right? And so that's on one side. On the other side, when we went to the financial institution, they're saying, no, we don't want to serve the space. We do not know how the risk is going to work. And we sort of have to give that comfort to them in a form of FLDG, loss guarantees and everything, saying, okay, we want to take that risk. We will cover the, the NPEs and, so that you would be secure. But over the period of time, right, as you have a historical data, as you have more tenure data, the institutions are coming forward and saying, okay, no, we are okay of serving this space. So I think it's not a sprint. It's actually a marathon, is what we realize that part, in that sense that, you generate long enough data, transaction data and the repayment data, the institutions are actually okay of doing that part, because this, you're talking about space which was not really served earlier, right? It basically opens up more opportunity for them to really deploy the capital, right, at the end of the day, right? And in some cases, most of them, if you talk to large NBFCs or banks, they have a short cycle debt which is available, which you can actually deploy in these kind of products. So I think now everyone's trying to see the value, but getting the first NBFC financial institution, getting the first partner was a difficult job for us to do that. Now we have made a case study out of that, and it's become an easier pitch to go to the new partner and saying, no, this is the data which we need, and this is the benefit you can get out of it, right? So yeah, that has been our experience in at least in India.
Great. So something I heard with what you said was one of the challenges, besides being the first, was sort of convincing the institutions who have the data to share that data. So now I'm going to turn that question around to Tim and Tanah and ask, what do you need to see from financial institutions and fintechs that you would partner with that would give you confidence in sharing your data? And I'm going to actually throw Javier's question in here as well. And how important are appropriate regulatory frameworks for data sharing in giving you that confidence?
Come on, Tanah.
Well, actually, I'm very fortunate today because I have a former colleague of mine, Max, on the call as well, and he's been kind of in the chat sharing some information regarding this as well. I mean, we work with the Financial Services Authority, or OJK as it's known, in Indonesia. They actually have quite clear kind of regulations around P2P lending and fintech companies and the type of transparency and disclosures we have to report, especially now, since as of April, we're a public company. So I think from a regulatory standpoint, it's getting to a place where we can have more confidence, at least from that perspective. In terms of the types of partners in financial institutions that we're looking for, look, I mean, we work with so many here already in Indonesia and across the region as well. I think those that are as credible as possible, who are mission aligned in the sense that, these are not just potential consumers. Here, we're really trying to, or not just about expanding your consumer base, but rather really moving the needle in terms of what it means to serve those that have historically been underserved, and especially in a market like Indonesia, where for generations we've had such, a growing wealth disparity that continues and is prevalent to this day. It drives a lot of the social instability and grievances from, and rightly so. I think as a parent myself, I want to know that my kids are going to have a better opportunities than I did. And for so long in a country like Indonesia, that's not been the case because the system has been set up against them, has been set up in a way that serves the 1%ers, right? And so how do we, as not just a company, but as an ecosystem, change that and work with the policymakers to make sure that the financial institutions that we work with are also, falling in line, and also, with that same kind of objective or as a North Star, work with us, and because we are essentially the future, right? Companies like ours are the future, and that's the way it's going. So yeah. I didn't list out a very nice, neat set of traits, but maybe Tim can do it in a much more articulate way than I did.
I mean, ours is interesting because it's so much more nascent. So a lot of the work that we do with our partners is around trying to introduce flexibility into their policy and their view of the world. So much like Tanah, we work very closely with both the central bank, but also the sort of data governance bodies in Uganda around sort of the data sharing piece, and we still feel very comfortable with the frameworks. But actually, where data and where our partners kind of come to bear is, we've got someone will come to Uganda that's got experience in lending in Indonesia to SMEs or to drivers, and will be interested in deploying their balance sheet in Uganda. And actually, the characteristics of the gig worker are totally different. Their work habits are different, the way they consume financial products are different. And so a lot of what we do is, a lot of the work we do is looking for partners that, are happy to spend some time, go deep, be flexible, understand, that a driver in Ibadan in Nigeria is not the same as our driver in Kampala. And they're not the same as them lending to a GoTo driver in Indonesia, for example. So for us at the moment, given the kind of nascency of the market, responsibility around how they handle our customer and driver data is obviously paramount, but also a flexibility in terms of how they view the end customer and how we kind of fit the data to their models.
So interesting. So what I'm hearing is that, regulatory and other data sharing frameworks are critical, obviously, but what may be the secret sauce of the partnerships is sort of a mindset alignment and a sort of similar approach and objectives underpinning why you're actually engaged in these activities. Gayatri, I want to bring you in here because I know that we have some ingredients that came out in our analysis of successful partnerships between financial institutions, fintechs, and platforms. Do you want to talk about that for a few minutes?
Yeah, and actually, the way I might do it is to just actually paint a picture of how many partnerships are actually happening in this ecosystem to make things work, right? And based on what the panelists here said, I think one thing to foreground is at the center of it all is actually a partnership between a platform worker and the platform. That is the kind of primary kind of rubric in which we're fitting in these financial services, right? And so that is also a partnership that will transform with the introduction of financial services in the system. So for instance, so far, platforms and platform workers are engaged in a partnership that involves a livelihood exchange. They're providing a means for livelihood. These guys and women are taking them on. What happens when platform workers introduce financial services for their workers in this system? How do they transform from seeing their workers as actually part customers of services that they provide? So that's also a shift. I think that's important because what it contains within it is the better design and delivery features that we have to think about when we're bringing services to this segment that might be very different from the platform's own customer segment who are buying things, availing services, and look more like an affluent class of people. Like, how do you serve this segment while also retaining an engagement of work? Secondly, the fintechs coming in, the financial service providers like KarmaLife, are bringing in the expertise of the financial services that they understand and that they're designing. And how do they partner with platforms who have built possibly a great customer experience already, a great user experience on their app, but now have to fit in kind of the logic and the regulations and the features of a financial product into the system? How do you disclose these products? How do you make sure they are brought to the workers in a way that's responsible, that's clear, but at the same time builds on that trust that the workers already have in the system? So it's very important what we saw in the assessment of services that we did, is that the workers already trust this ecosystem that they're in. If they are in a platform that they largely despise and think is out there to exploit them, no perfect financial services product will work in such a system, right? And actually what Rohit brought out is very important. Behind the fintechs are often legacy or traditional underwriters of whether credit or insurance or other products, who are maybe still practicing a fairly conservative and maybe for the right reason attitude towards provision of these services, right? So we may think the work data should unlock a car loan, but actually that's not where the equilibrium of the industry is today. Today, it's a percentage of your earnings. This is some research we did with Malika and BFA that really showed us that for loans that you and I take when we invest in our lives, right? They're multiples of our earnings. Think of a house loan, a car loan. It's much more than what we earn in a month. The equilibrium available for platform workers is a percentage of their earnings, 50% of what they earn in 2 weeks at best, right? And we're trying to change that, or trying to see how responsibly you might extend that loan amount, or you might more customize that insurance product. But today, that confidence, that market confidence is not there. So that's also a partnership we need to work on to make sure that those systems actually follow through and adopt and expand to fulfill this vision. So just to say that it's a complex set of kind of partnerships that are happening. I think centered to it is the workers' trust in the overall system and the fact that we onboard services here that fit into their livelihood. So that's what I'll say for now.
Perfect. Thanks, Gayatri. I want to pick up some specific questions that have been submitted in the chat in our last couple of minutes. One, I think maybe Rohit, you'll have probably some thoughts on, potentially Tanah and Tim as well. But there was a question about obstacles to the transition between asset-based and cash flow-based financing for platform workers in particular. And how those might be overcome in the Indian context. Can you take that one?
Sure. So we are not really focused on the asset-based financing because it's the way we have found out the need is that there's a need for managing your cash flow fluctuation. I think Tim also sort of pointed out that, right? Versus you have a long-term lumpier expenses, lumpier need, which can be for medical emergencies, which can be for house repair or buying a asset, buying a bike, right? So I think the solution for the second one, which is asset-backed finance, asset-backed credit, is slightly at a mature state, better state compared to the unsecured loans, because of the traditional underwriting still works there compared to, they don't really need to use the work data for really doing that part, apart from just, the platform behaving like a facilitator or intermediator between the work, connecting the worker with the financing provider. Otherwise, we have not seen that part that, it's just two different needs actually, your expenses and earnings are never aligned. Luckily for people like you and me, we have the credit cards to manage that part. The solutions which we are working out actually equivalent of that, where it can help you to mitigate those short-term liquidity needs you have, and then you have a longer tenure product which can be either backed by which can still be unsecure and can get paid over the period of a couple of months, which that's what we are working with CGAP right now. Otherwise, you can also have the same thing, which is backed by an asset and get paid over the period of time. See, one of the challenges which, when we were exploring that, for example, we were exploring a two-wheeler loan for the gig workers, and the challenge which we faced there was that the overall utilization of the tool is too high for the workers, right? So, again, if you really want to get the work data, one way is that you just price the risk itself, right? That's most of the two-wheeler lender have done in India. Second is that you actually factor in the earning part of that and see if you can reduce the cost of that. But as of now, we are not seeing that, but we have not done that part, and I won't be having really a clear answer of what is the transition. But for sure, I can, based on the behavior which we have observed, these are very two very different needs actually. Getting access of liquidity on demand versus something which is long tenure, lumpier expenses backed by nascent, is a very different need.
And there was also a curiosity about, are you offering unsecured loans to first-time borrowers who may be on platforms, or is there an on-ramping process?
No, so it is. So we, for all practical purposes, we don't really check the bios score of the people because we believe that's not really a right representation of their behavior or their creditworthiness. So it doesn't really matter to us. Although based on, again, the survey data which we have is a majority of them are the other first-time borrowers, right? But that's not really the criteria which we follow as while we do a partnership. As I said, right, the objective with which we approach the platform partners are that we should be able to serve a majority of their people utilizing the work data. We traditionally from the underwriting point of view, we have made a very clear difference between eligibility and the limit part of it, right? So pretty much we make everyone eligible, and limits we try to make it sustainable. So if I do not know how to underwrite you or how to assess your risk, maybe give him at least a portion to build that history with you, right? Start with if Rohit is getting, say, $100 and Rani can get $200 as a loan because just that KarmaLife has more data about Rani, right? That's how we try to do it and try to build that history with us, which can actually give us more confidence, more data to now start giving them a longer, a larger credit. So it's not really first time, thin profile, bad bio history. It's just that how much we know about him based on the work data. And if we have less confidence, just maybe start with a small relationship and see if we can build on top of that.
I like the way you frame that as finding the sweet spot between eligibility and sustainability.
Yeah.
On the two-wheeler issue, though, I think, Tim, Safeboda has quite a bit of history in providing two-wheeler finance. I think you alluded to it before. Can you talk a little bit about how you have overcome some of those obstacles?
Yeah, so just to be clear, so for the two-wheelers, we partner up. So we have two partners within Uganda and also in Nigeria that we kind of work with for the financing. So it sits off our balance sheet, but we obviously provide a lot of the operational support for it and are really the access point for our drivers into that financing. And I think for us, it's maybe a slightly sort of strange relationship in a way, and a bit different to the kind of unsecured space where on day one where a driver comes to Safeboda to join us, they tend to walk out with $1,000 asset financing loan before we really have any formal relationship with them at all. They've kind of given us their KYC and they've joined the platform, and they kind of walk out of our academy in Kampala with 2 helmets, a new phone, sometimes a new bike, and kind of reflective gear. Actually, before we have really any credit data on them, which is a slightly bizarre, I guess, way of doing it, but unfortunately that's sort of like the necessity. But as I said at the start, the kind of repayment rates for very productive economic capital remain very high.
And Tanah, what about GoTo or Gojek's experience in this space? How has it managed the initial capital entry requirements of drivers into the ride-hailing business?
So I think, for us, we do a KYC. We have our own KYC process, obviously, to make sure that our drivers have the driver's licenses and that the vehicles are up to date in terms of the parameters that we've set, safety parameters that we've set. In terms of capital, look, we don't have any barriers in that sense for our drivers to be able to become drivers on our platform. But again, after a few months of data, I think we're able to assess where they're at or place them at least in terms of some of our financial inclusion focused programs. And then from there, that's where we actually start targeting some of the types of training and I hate using the word upskilling, but the types of reskilling programs that we offer as well, because that's also something that's quite critical for us, right? Maybe a Gojek driver doesn't want to be a Gojek driver forever. And so how can we also cater to those needs and wants as well, so that our drivers do have other opportunities for income generation on our platform that are outside of just being a driver, and also noting their profiles and their behaviors, meaning some of them are full-time, some of them are part-time, and as mentioned, some of them drop off after a certain amount because for them that's sufficient for the day and that's all they need, and they are, you know, they spend the rest of their time doing other things, whether it's income generating or not.
Great. Well, I think we are nearing the end of our time together. So I would like to conclude with a little bit of a lightning round. So I'm going to ask each of you the same question and 2-sentence response. What is your answer to the question? Our financial services for our platform workers will have been a success when? And I'm going to give our panelists a few minutes to think about it, but I'm going to start with you, Gayatri. Based on our research, not our financial services, but financial services in general for platform workers will have been a success when?
Yes, let me try and actually see 2 specific questions to us from 2 guests that I can use as anchors to answer this question. I think somebody asked a question on insurance, and I think, you know, when we think of the insurance space for platform workers, it's even more nascent than credit, meaning that yes, some kind of group product exists that platforms can take on from an insurance provider or an insurtech and bring into their system, bring into their platform. But these insurance products are largely not very suited for platform work yet. And so I think we'll be successful when we can customize those insurance products to more suit platform life. Maybe a cell phone screen breaking, maybe a insurance against dengue fever, things that can really come in and provide visible value to a worker while still retaining some of its traditional logic, because we need that. Insurance models cannot overhaul overnight. So yes, keeping those kind of risk-based factors, business model factors in mind, how can these products stretch just a little bit, given the opportunity of platform rails and data, to more customize to a low-income worker's life than we have been able to do before? I think that's when we'll be successful. I think as a sector, for all of us gathered here who work in financial inclusion, I think something that Gerard said earlier is important. We really need to understand this segment. In some ways, in most ways, they are very similar to informal workers largely, who as financial inclusion actors go, we haven't been that successful in reaching. So truly understanding their needs and understanding how those needs can be better served in this ecosystem. So taking a very segmented approach, not having a blanket approach that a ride hailer in Lagos is very similar to an e-lancer in Mumbai. They're not, they're very different. They have different needs. And especially the differences between men and women, something brought up in the questions as well, is also important. Women may occupy much nicher places of this world. Their digitization will look different, messier, nicher, less in the spotlight. So we have to understand those digitalizations as well as we're understanding the big, changes happening in ride hailing delivery. So just taking that big multidimensional approach. Those are my 2 points. Thank you.
Fantastic. And thank you for capturing those 2 other questions in your response. All right, I'm going to cold call someone. Tim.
So I think our financial services offering to our drivers will be a success when our drivers are consuming all of the products that they should be consuming. Now, what I mean by that is, when we've got drivers that understand the benefit of having a segregated savings wallet to save for school fees, where they are paying the marginal cost for life insurance for their family or for them on top of the insurance we provide them for their bike. It's about taking out, a loan for an EV bike because it actually makes sense, drives down their costs, better for the environment. So it's about us sort of educating around the kind of benefits of the financial products and also the provision of those products in a way that kind of our drivers see the benefit of all of them. So it's kind of part financial literacy education and part product provision for us.
I'm going to jump in there because I double. I mean, look, with Tim, very similar, models. I think we could say the exact same thing relevant for our drivers when we start seeing that uptake of the financial products and services that are geared towards long-term, planning, and that's what it's a reflection of. For our merchants, it's a little bit more straightforward, right? It's the business growth that we see on our platform. It's the increasing number of transactions that they're having. They're in some cases expanding beyond just their original venues. So I think this is something that we're constantly tracking. And yeah, we hope that's for us the best indicator of success. Pretty straightforward.
Thank you.
Yeah. So as Gayatri mentioned, right? I think credit always stays as a central point of all the discussions, but the contextual, meaningful accessory insurance is one of them, which we would also like to bundle it and package it together. See, you and me can compartmentalize the finance in that sense, right? And unfortunately, whenever we talk about financial inclusion for underserved people, we always think from those compartments, right? That I have savings from somebody, I have insurance from somebody, within insurance, I have motors from somebody, life from somebody, health from someone else, right? But I think the people of this space this segment cannot really do that part. So I think, if you can actually create an experience for them, which of course has to start with when they're with the platform, but which can go beyond if they even leave the platform, where it can take care of holistical financial health of the people, which is insurance, credit, savings, and pension, I think would be a great way of thinking about that. But I believe that if at all there is a unified new experience which has to exist, it's actually for this segment of the people, because they cannot just really understand what is the utility of insurance, what is the utility of saving it for the future, what is the utility of, let's say, pension. So I think first is bringing them as part of the giving them the giving the coverage when they're working with the platform, and once they leave the platform, also continue to get the benefit. I think would be the larger goal, at least what we are chasing, and we believe then it would be successful. If we are not able to build on top of the insights which you have gathered while they're working with the platform, and continue to serve them after they've left the platform, I think that would just defeat the purpose of working with getting access of the data, which is deep enough for underwriting.
It's an excellent point. I think a great one to conclude the panel on. I'm hearing a lot about simplicity. I'm hearing a lot about being streamlined, that experience, and I'm hearing a lot about it being sustainable, both within the context of one platform and across the workers' economic life and otherwise. And I have to say that is why CGAP is engaged in this space as well, because much as we recognize, and I think everybody recognizes, the risks and the volatility that can accompany platform income, it's not necessarily more volatile than other informal sector income, but it is volatile. We do also recognize the potential of these kinds of financial services, appropriate, streamlined, simple, sustainable financial services, to help low-income people minimize the risks and maximize the considerable upside. And so that is why we are engaged in this space and with these particular organizations as pilot and advisory partners, as well as several others, which I'm now going to hand back over to Xavier Faz to tell you a little bit more about. Please join me in thanking our panelists and welcoming Xavier back.
Thank you, Rani. This has been a great presentation. We'd like to take the opportunity now to announce the launch of 5 partnerships between CGAP and fintechs, platforms, and financial service providers to pilot innovative financial services for platform workers in a way that supports and improves their livelihoods. These partnerships involve Abalogi, a digital seafood marketplace in South Africa, Britam, an insurance provider, and Little Cabs, a ride-hailing platform in Kenya, Jumia, an e-commerce platform in Africa, KarmaLife, a fintech service provider for platform workers in India, and Safeboda, a community-based urban transportation network in Africa. CGAP has also joined the Sustainability Advisory Council of GoTo, as was previously mentioned in the panel. GoTo is the merger of Gojek and Tokopedia, and e-commerce and ride-hailing platforms in East Asia. And with this, I'd like to close today's session, thanking all of you for joining this presentation and discussion, and especially thanking our guests for their extraordinary contribution to the conversation. as well as my CGAP colleagues who led moderated this conversation. Thank you, everyone, for joining.